Should you buy whole life insurance or indexed universal life insurance? Hi, I'm Brandon, founder of the Insurance Pro Blog, and by the end of today's video, you will have a solid understanding of the benefits and drawbacks to both product types so you can make an informed decision about which one is the correct choice for you. Let's start with a discussion about stability or the lack thereof. When it comes to year-over-year earnings, some people like to see a consistent growth pattern with very little volatility to the actual earnings of their investments or savings, or in this case, life insurance policy. And if that is you, whole life insurance is probably your best bet. The earnings in terms of year-over-year growth on whole life insurance cash value as well as death benefit are going to be extremely stable. This is the case because whole life insurance has a higher guaranteed accumulation rate than will be the case for most universal life insurance cases, plus a dividend that is not guaranteed but incredibly consistent. Most insurance companies that are engaged in issuing dividend-paying whole life insurance have consistently paid dividends for over 100 years, and it is an incredibly important piece to their overall culture. Ensuring that dividend payments continue to take place to policyholders is a business operation that mutual insurers engaged in the issuance of dividend-paying whole life insurance will die over. They will do whatever they can to maintain the integrity of their dividend. Some companies even have a dividend reserve, a cash position that they keep to, in essence, buffer the potential fluctuation of dividend payments in leaner years. Alternatively, indexed universal life insurance earnings are much more volatile. They're tied to an index, typically stock indices, in some cases bond indices. And because they are dependent on the movement over a certain period of time, most commonly 1 year, of a certain index, the payment of interest on cash value is going to depend on that index, and it could be zero. It could be something much, much greater than what you'd receive from a whole life insurance policy. But if you don't like that fluctuation, indexed universal life insurance is going to cause you a lot of frustration. If you're okay with that, then there is a reward for the volatility. In general, we would anticipate that the overall growth rate of indexed universal life insurance is going to be long-term higher than whole life insurance. But it comes with the understanding that there will be lean years, and there will be years that interest earnings are zero. And that can be very, very disappointing. So if predictability is your thing, whole life insurance is the right option. If you're a little more willing to risk the year-over-year earnings, indexed universal life insurance is a great choice, especially given the likelihood that it will return in a higher overall rate of return over the lifetime of policy ownership. Now, what about flexibility? When you buy life insurance, you want to know what your commitments are. And for a lot of people, especially those looking to build cash inside a life insurance policy, the commitment that you make is going to be somewhat substantial. And you understandably want to know, how committed are you in terms of year-over-year payments to this life insurance policy? The good news is for both whole life insurance and universal life insurance policies, when done with cash accumulation as a primary objective, flexibility will always be on the table. But the degree of flexibility will vary considerably between whole life insurance and universal life insurance. At its core, universal life insurance is a very flexible insurance product with a very flexible premium that is almost entirely up to the discretion of the policyholder. So if you need year-over-year high flexibility because cash flow may vary considerably, universal life insurance is very likely your better bet. Whole life insurance will, in fact, allow for a certain degree of changing the amount being paid into the policy year over year, but there are a certain number of limitations or consequences of changing the premium on a whole life insurance policy. Let's start with some basics. So for whole life insurance, the mechanism that allows us to create a flexible premium is the paid up additions rider. The paid up additions rider in most cases can be adjusted year over year, month over month, whatever the frequency with which you pay into the policy is. So you have the option to change the amount of money going into the paid up additions rider, and therefore we accomplish a flexible premium or less commitment, if you will, on an ongoing basis to the life insurance policy because paid up additions are entirely discretionary. But whole life insurance paid up additions do come with some requirements in order to keep them active. And some companies don't have the most lenient policies when it comes to adjustments. What I mean by this is, if you own a policy that you change the paid up additions rider on, some companies will allow you a certain window of time where you must return back to whatever the maximum amount of paid up additions was that you were paying. Otherwise, your new reduced amount becomes the permanent maximum amount of money that can be paid into the whole life insurance policy. For example, let's say you buy a whole life policy with a $20,000 a year premium. $5,000 is your base whole life premium. That's the amount of money that you should, in best practices, pay each and every single year. $15,000 of that premium is paid up additions. It's entirely flexible. You can pay whatever you want to, $0 or up to $15,000. If you have what is known as a level paid up additions rider, making adjustments to that $15,000 comes with the very real potential consequences that reduction becomes a permanent reduction. Most companies with leveled paid up additions riders will allow you to adjust downward for maybe a year or two and then return back to the maximum $15,000. But if you remain at that reduced amount for a longer period of time than this 1 or 2 year period, then whatever the amount you have been paying into the paid up additions rider becomes your new maximum amount. So for example, if you start at $20,000, but 3 years in, you reduce your payment total down to $15,000, which means you've effectively reduced your paid up additions payment down $5,000, and you leave it there for 5 years, it will almost certainly be the case with a level paid up additions rider that moving forward, $15,000 is the maximum amount of money that you can pay into the policy. There is one other type of paid up additions rider. We call it a flexible paid up additions rider, and this comes with far fewer restrictions. You do not have a window of time that you have to return to the maximum amount in order to keep that active. There may be certain minimum commitments you have to make in terms of paying a certain level of paid up additions into the policy over a certain period of time in order to keep the rider active so that you can continue to put this additional $15,000 into the policy. But if you were to choose, for example, after 3 years of paying $20,000 in our previous example, to reduce your premium down to $15,000 or $10,000, you could stay there for quite some time and you would have the option to go back to your $20,000 maximum with a flexible paid up additions rider because it doesn't really care about maintaining that full $15,000 paid up addition amount over a longer period of time. So the critical thing to understand when buying whole life insurance is what type of paid up additions rider you have and if reductions paid to the paid up additions rider will result or could result in permanent reductions to the amount of money you can put into the policy. In addition to all of this, if you make a reduction to the amount of money you're paying into your whole life policy, most life insurance companies will allow you to make up that reduction in the following year and in the following year only. So, for example, using our $20,000 per year premium life insurance case, if you reduce your policy down or your payment down to $15,000 and decide in the following year that you'd like to return to your $20,000, there's a chance you may actually be able to pay $25,000 maximum into the policy. What you're effectively doing is making up the difference of payment that you could have made in the prior year but didn't. But if you do not choose to put in the full $25,000 in the following year, then you will forfeit that $5,000 reduction that you made in the year prior. So 3 years into the future, you can't go back and make up that $5,000 reduction that you made from the past. None of these rules apply to indexed universal life insurance. Universal life insurance doesn't have a paid up additions rider. The premium is entirely discretionary, so long as the expenses associated with the policy get paid. And they can be paid either from the premium that you pay or the cash value as it gets deducted from the life insurance policy. Everything else is entirely up to you. So if you have a $20,000 maximum premium universal life insurance policy, you can bring the premium all the way down to $0 without any incidents or concern, provided that you have cash in the policy to cover the expenses of it. There will never be a new restriction on the amount of premium that can go into the policy because you reduce the amount. So from our prior example with whole life insurance, if you own an indexed universal life insurance policy with a $20,000 a year premium and you bring the premium down to $15,000, you can leave it there for a long, long time and then return back to the $20,000 premium. Nothing stops you from doing that. In addition, you can make up those reductions in years far, far into the future. The ability to go back and make up any payment that you didn't totally use in a prior year with indexed universal life insurance is technically speaking, unlimited. Now, practically, there could be a couple of restrictions that stop you from doing this in the fashion you may be thinking at first, which simply means you might have to break up making up those reductions into a couple of different years versus one huge lump sum if you were to underpay the policy premium for a number of years. But just understand that with universal life insurance, there is no restriction on the payment of premium up to the maximum that is established at issue. And if you don't use that, it will accumulate year over year over year, and you could go back and make a pretty substantial lump sum payment to a universal life insurance policy, which is not always available on whole life insurance policies. In fact, it's rarely available on whole life insurance policies. And one more unique idiosyncrasy here, when it comes to building life insurance policies for cash optimization, we have to balance the tax rules that govern what is and what is not a modified endowment contract and what does not qualify as life insurance. And that is very much tied to the amount of premium that you pay relative to the death benefit that is in force. With universal life insurance, we have a lot more granular control over the death benefit and making adjustments to the death benefit after policy issue that make it more easy to match your changes in plan premium to death benefit to optimize cash value growth moving forward. Those options aren't always on the table for whole life insurance. So you kind of got to know with a certain higher degree of certainty what the likelihood is that you're going to continue to pay the premium that you started out with on a whole life insurance policy, whereas there's a lot more flexibility to make adjustments on the fly with a universal life insurance policy. Now, if you're trying to address the dual goal of cash accumulation and the establishment of some degree of death benefit, whole life insurance does bring some serious benefits to the table. Because of the way whole life insurance functions, it requires more death benefit than universal life insurance will to remain compliant under tax code as a life insurance contract. So in some cases, when an individual looks to put a set amount of money into life insurance, whole life insurance will create more death benefit, which might be attractive if you need to establish a certain amount of death benefit in force. It's also possible that whole life insurance policies will create more legacy value, money that you could leave behind, because the death benefit will, for a certain degree of time, most likely be larger than the death benefit you'd create on an index universal life insurance policy, again, holding premiums equal. So if we are planning to buy a life insurance policy primarily for cash value accumulation, but considering death benefit as well, and let's say, again, we're going to put $20,000 into the policy, we'll definitely see that the whole life policy has more death benefit at issue, and it maintains more death benefit for quite some time. Now, over much longer periods of time, indexed universal life insurance, because of its likely higher rate of return, could create an overall death benefit that does exceed what we would get out of a whole life policy. But this takes a very long time to materialize. So if you're buying the policy kind of later in life, or you're not as concerned about what that difference in death benefit will be by the time you live to age 90, if you make it to age 90, then this is less of a serious consideration, and whole life insurance will maintain a higher death benefit at a sooner period of time, or throughout a point of your life where perhaps dying prematurely will be more destructive. If your focus on cash accumulation in a life insurance policy is more short term, in other words, you intend to make use of the cash value buildup, there are some things that will bounce between benefits for whole life insurance and index universal life insurance. If, for example, you intend to take the cash value of your life insurance policy and pledge it as collateral for a loan from a bank, this will be much easier to accomplish with a whole life insurance policy than an index universal life insurance policy. It just happens to be the case that banks are in general more familiar with and more comfortable with lending against whole life cash values than they are index universal life insurance policies. That's not to say you will not be able to use index universal life insurance for this case. It's just that there will be many, many more options with many, many more banks if you're pledging whole life insurance versus index universal life insurance. Perhaps as time goes on, banks will start to adjust their views on this and accept index universal life insurance more frequently. But for now, understand whole life insurance is the preferred option if employing this strategy. If you simply intend to take loans or surrenders against your life insurance policy and skip the bank process, whole life insurance will have an advantage for the first couple of years because, in general, the surrender charge that is always a part of a universal life insurance policy will impede some of the available cash value in early years. After about 5 years, this difference will probably go away. But again, if you're intending to take money from your life insurance policy within 5 years of issue, whole life insurance will tend to have a little more cash available than will be the case with an indexed universal life insurance policy. If you're in the market to buy life insurance on a child and your plans are to put more than maybe a couple $1,000s into the policy each year, indexed universal life insurance will, in many, many cases, be your better bet, possibly your only option. This happens because the death benefit created on a whole life insurance policy as the premium amount increases becomes prohibitively large. Insurance companies very much worry about the death benefit that's being put in place, and they also want serious financial justification for the death benefit on a child when we're talking about death benefits of several $100,000. When you are putting more than just a couple $1,000s per year into a policy on a child, you're going to end up with a death benefit that becomes extremely difficult to justify from a financial standpoint in most insurance companies' eyes. Universal life insurance, on the other hand, maintains a much lower death benefit per incoming premium, and this typically doesn't require near as much financial justification because the death benefit is not nearly as large. To give you an example, just so we can sort of quantify what kind of differences you might be looking at here. Let's say you want to buy a life insurance policy on a child and put $10,000 per year into that policy. On an indexed universal life insurance policy, it's probably going to create a death benefit of a couple $100,000. On a whole life insurance policy, there's a very good chance you'll have $1 million+ of death benefit created in order to remain modified endowment contract compliant. If your focus on the life insurance purchase is much more death benefit oriented, so cash value is not really that strong a consideration, whole life insurance will maintain several advantages. First, the death benefit of a whole life insurance policy is always guaranteed. The initial death benefit is always guaranteed, provided that you pay the base premium through the required premium payment period. This same guarantee is typically not available on indexed universal life insurance, or at least not as a lifetime guarantee. This is evolving, and there will probably be more products available as time goes on that do create a higher level of death benefit. But what you'll probably find is the balance of death benefit guarantee and the buildup of cash value will always be, from a combined perspective, a little stronger on whole life insurance than will be the case for indexed universal life insurance. You should also know that if you are looking to establish a guaranteed death benefit over a premium payment period that is defined less than your lifetime, so a 10 pay or a 20 pay or something along those lines, whole life insurance will contractually guarantee that result. Indexed universal life insurance will never guarantee that result. It is close to get something that effectively creates a guaranteed-ish death benefit, but it is not ironclad, contractually guaranteed. Now, in an effort to try and help you further understand how all these things work, let's run through some common myths that are associated with both whole life insurance and indexed universal life insurance so that you can start to parse what is fact from fiction when it comes to your decision-making process. Let's start with whole life insurance and the fact that it's issued by mutual companies who always have your best interest at heart. This is true in spirit, but the evidence is very mixed that it is in fact the case that whole life, dividend-paying whole life issued by mutual insurance companies will in fact outperform everything else that's out there. There are non-mutual insurance companies that deliver less value, but there are non-mutual insurance companies that deliver a whole lot more value. So there's not much that we can point to that definitively says you should always buy from a mutual life insurance company and therefore dividend paying whole life insurance because your ownership is vested in that company and therefore they will do the best to create value and return it to you. There are many indexed universal life insurance policies issued by regular stock and privately owned life insurance companies that provide just as much or greater value than whole life insurance companies, whole life insurance policies issued by mutual companies have delivered over the years. It's mixed, and circumstances are very much going to drive the right decision for you. In addition, there are a lot, and I mean a lot more non-mutual insurance companies issuing universal life insurance policies than there are mutual companies issuing whole life insurance policies. So the somewhat niche focus of whole life insurance, especially dividend-paying whole life insurance issued by mutual insurance companies means we have a very small sample size to pull from, whereas we have this huge collection of non-mutual companies issuing universal life insurance policies, which may not always be intended for the same objective. And there tends to be times when people intentionally or unintentionally make a mismatch between policy design and objective to individual circumstances, and they use that as evidence that something is bad or something is good. So understand that the data is very mixed, but mutual insurance companies do vest ownership in their policyholders. They do have a fiduciary duty to their policyholders. And in general, when people buy dividend-paying whole life policies from a mutual insurance company, they benefit. But we can't say that they will always benefit more than people who buy insurance products from non-mutual insurance companies. Next up, whole life insurance is a safer product that has higher guarantees. Well, yes, whole life insurance has higher guarantees. Does that necessarily make it safer in all circumstances? That depends. So if we were to only receive the guaranteed feature of a whole life insurance policy, I think most of us would be fairly underwhelmed by what we got out of it. Remember, the death benefit does not grow in terms of the guaranteed features of a whole life policy, and cash value growth is fairly minimal on the guaranteed side of things. And while it is true that the guaranteed accumulation of cash value in a whole life policy is significantly higher than the guaranteed cash value growth of stocks or universal life insurance or most other products people tend to use as long-term savings, it's still not generally going to be enough to get you to the objective you are driving towards when it comes to retirement or just building overall wealth. So it's good, and there is a safety element to it, but that guarantee is oftentimes overstated when it comes to what that will actually deliver for results for you. It's also worth noting that while whole life insurance is by no doubt the much older product style, universal life insurance has existed for many decades, and even indexed universal life insurance now has a history going back a couple of decades. So it has existed throughout some pretty challenging economic circumstances, and it has done just fine. In fact, I would argue that in 2008 and 2020, two periods where indexed universal life insurance was definitely alive and functioning, it performed a little bit better than whole life insurance did at those moments. Next, whole life insurance is an outdated product that makes no sense in today's environment. Whole life insurance is definitely a more conservative and older style savings tool, but don't count out its ability to accumulate value and offer immense after-tax benefits. It has an extremely high risk-adjusted rate of return. So when we compare what we get out of the accumulation of death benefit and cash value on a whole life insurance policy compared to reasonable alternatives like bonds or cash, it does extremely well. It's never going to blow the doors off and do things like much more risky exotic stock options or certain commodities that have run up quite significantly in recent years. It's not going to do that, but it's also not going to have the risk profile that those much higher, riskier investment options have. Whole life insurance is boring, but there are times that boring can be really good, and whole life insurance is a very tax preferential savings plan. It accumulates cash value on a tax-deferred basis. You can distribute from it on a very tax-favorable, effectively tax-free basis, significantly augmenting rate of return, especially for those in higher income tax brackets. Dividend performance is strong, and insurance companies who issue dividend-paying whole life insurance policies are extremely focused on continued payment and continued enhancement of dividend payments on their life insurance policies. It's not a whiz-bang product, but it is an extremely stable and reliable product, and for that, it deserves consideration. Next, whole life dividends are not guaranteed, and most likely will overstate policy performance. This is a claim that gets a little bit of wind beneath its wings from past experience. There was a period in U.S. history when interest rates were extremely high, and therefore dividend rates followed suit. Whole life insurance is a very interest-sensitive product, so when interest rates economy-wide are up, dividend rates tend to go up, and when interest rates go down, dividend rates tend to go down. Now, they do tend to move more slowly than other interest-sensitive products. Think bonds or CDs. But there was a point in U.S. history going back to about the 80s, late 80s, early 90s, when interest rates hit their peak and dividend rates hit their peak, And a number of people sold whole life insurance for a short period of time based on some extraordinarily lofty projections that made a number of people think their whole life policy was going to do something it almost certainly was never, ever going to be able to do. This resulted in severely inflated expectations and a multi-decades long period of declining dividend rates because we had a multi-decades long period of declining interest rates. That is not indicative of an industry-wide sham looking to convince you that whole life insurance is far better than it really is to dupe you into buying it. The circumstances are just the circumstances here in terms of how things worked out. But we also sit at a point where interest rates are much, much more temperate than they were going back to that period of time. So the movement in dividends from here is likely to be substantially less significant than took place if we go back to the late 80s, early 90s, and move forward to today. But even if we do run into a period of a run-up in interest rates and a run-up in dividend rates, those who do own whole life insurance are going to benefit from those higher dividends when they exist. In fact, there was a policy, a real policy shared years ago that had about a 20-year history with a real rate of return on cash value of approximately 7% because that policy was issued during that high interest rate period. Now, likely, the policy has declined in terms of overall effective rate of return. Sadly, we don't have any new data on it since about 2007, so we can't track what's happened since then. But if we see a rise in interest rates and a rise in dividend rates, we will benefit from that if we own whole life insurance. Also, it's worth noting that the payment of dividends greatly enhances the guaranteed accumulation features of a whole life insurance policy because once a non-guaranteed feature has actually taken place, it now becomes part of the guaranteed aspects of the life insurance policy. Once cash value exists because dividends created it, that cash value now earns the guaranteed interest rate payable under the whole life insurance contract. That enhances the overall growth of guaranteed cash on the whole life policy. And once a death benefit exists because dividends purchase paid up additions to create it, that also can enhance the outstanding death benefit on the policy forever and always. Let's skip over to Index Universal Life Insurance now and first start with the big one. You can't lose money with Index Universal Life Insurance. You absolutely can lose money with Index Universal Life Insurance, but not for the reasons you might be thinking. Because Index Universal Life Insurance follows an index. That index can be positive, it can be flat, it can be negative. And the cool thing about Index Universal Life Insurance is when the index is negative, you do not participate in that decline, with the exception of a couple of indexed accounts that are more recently conceived by a couple of companies that use this buffer strategy that might actually deduct from your cash value. But barring those situations and talking about more traditional Index Universal Life Insurance, if the index is negative, you simply do not receive interest, or you receive whatever the guaranteed minimum interest payment is. For some policies, that might be something like 1%. This being said, the policy, the Index Universal Life Insurance policy, will have ongoing expenses that must be paid. And so, if you don't earn any interest on the cash value in your policy, you could, in fact, see a reduction in overall cash value because of the fees associated with your Index Universal Life Insurance policy. Now, I want to be very clear about something. This is not the way Index Universal Life Insurance is designed to work each and every single year. These scenarios are much more the exception than the rule, but they can and do happen. And they'll most likely take place where people have stopped paying their premium, or they're very early in the Index Universal Life Insurance policy's lifetime. So while it's not a common occurrence, it's not a zero probability event. You can see your cash value decline in an Index Universal Life Insurance policy, specifically in years where the index is down and you don't receive any interest payment on your cash value. Next myth regarding Index Universal Life Insurance: it was designed to overpromise and underdeliver so it could dupe people into buying the policy. There was a period of time going back 12 to 15 years when the rules that governed how insurance companies, or more specifically agents and marketing agencies, were allowed to project cash value development in an Index Universal Life Insurance policy were quite unencumbered, shall we say. There was a lot of liberty that insurance agents and marketing agencies could take when it came to the assumptions that went into the interest earnings that would take place on the indexed universal life insurance policy. And this created pretty remarkable results in terms of cash value growth and also the potential income an indexed universal life insurance policy could create. These were overstated. There's no getting around that. But even back then, there were people like the folks at the Insurance Pro blog who suggested these might be very, very overstated results. Now, since that time, much regulation has come about to temper the expectations and the projections that go into indexed universal life insurance policies and bring them more in line with reality. There's also the possibility that certain provisions of the indexed universal life insurance policy that are critical to driving the buildup of cash may change over time. Things like cap rates and participation rates don't always stay where they are at issue. In fact, they rarely stay where they are at issue, and they can change. They can go up and they can go down. And if they go down, that will affect the overall rate of return of the policy. Now, if you start out with proper expectations, a reduction in cap rate or participation rate may have zero effect on the overall rate of return that you achieve. But if you start with super duper lofty expectations and there's a cap rate or participation rate change downward in your policy, that could significantly change results from your original expectations. Ultimately, you should know this. Indexed universal life insurance is a fixed interest style savings plan. Its rate of return is going to be in the neighborhood of other conservative fixed interest style savings plans, bonds, cash, things of that nature. Indexed universal life insurance is not going to exceed the rate of return expectations we set for things like stocks in the general stock market like the S&P 500. Yes, I know the policy is following many times the S&P 500 index, but that does not for a second mean that it is going to pace the S&P 500 in terms of overall rate of return. Next up, indexed universal life insurance in general will cannibalize itself through exploding fees as you age. Universal life insurance is a very full disclosure product. You are able to look under the hood and see exactly what's going on and where the money goes. This is cool, but it also has the tendency to be a bit perverted by people who want to sell against universal life insurance to suggest that seeing all of the ugly things behind the curtain exposes what the insurance company is going to do to screw you. Truth is, the expenses that would be associated with universal life insurance policies when they are put in force for cash accumulation are going to be a relatively small expense to overall cash value. Long term, we're talking sometime between year 10 and 20, we would generally expect the total expense against the policy to be roughly 0.5% of the overall cash in the policy. After 20 years, we generally see this expense more closer to 0.25% of the cash value in the policy. But there were some universal life insurance policies sold years ago with extraordinarily overstated expectations and extremely anemic premium payments that resulted in failure because cash accumulation never developed the way that it should have. These policies were sold as a cheap alternative to whole life insurance that never panned out, and it should have been very apparent to anybody at the time that if whole life insurance required an $8,000 a year premium for the same death benefit that universal life insurance claimed it could accomplish for $3,000 a year, something was wrong. It wasn't the case that the whole life insurance company was screwing anybody. It was the case that the universal life insurance salesperson was lying. And as should have been plainly predictable, the universal life insurance policy collapsed because the premiums that were paid were chronically too low and cash accumulation failed to get to a point where it could offset expenses as time went on. Also be understood that these were death benefit focused purchases, not cash value focused purchases. The good news is you have access to the information. You can get a full detailing of expenses of a universal life insurance policy so you can see exactly what expenses you will be charged for owning the policy. And if you do this and you look at expenses relative to cash value and you see that they are higher than 0.5% of all cash value projected to be in the policy, let's say a year 15 or 20, or 0.25% once we get out to like year 25 or 30, you have a problem because the policy is not optimally designed, which means you aren't talking to somebody who's really designing the policy well for you. Next, the income on an indexed universal life insurance policy is so high, we can't figure out why everyone doesn't own one. Indexed universal life insurance, like fixed life insurance contracts, is a strong generator of consistent retirement income. It comes with a boatload of benefits, tax-free benefits, and it's well worth considering as part of your overall retirement income strategy. but it is not the panacea. It is not going to work for everybody, and it's not going to exceed all other options that exist to everybody when it comes to choosing appropriate retirement income assets. There are also things that are done to manipulate the projections of indexed universal life insurance policies to overstate the potential income capabilities of the product, and this is bad. It does not mean you should avoid indexed universal life insurance. It means that you should set proper expectations and make the decision on whether or not it's right for you from there. The easiest, simplest way to figure out what sort of income you might be able to expect from an indexed universal life insurance policy is to figure out what the cash value projection is at the time you plan to retire and assume roughly a 6% withdrawal rate. That number is pretty sustainable with indexed universal life insurance. If that works for you, then you should consider indexed universal life insurance. If that doesn't work for you, then indexed universal life insurance is out as an option. There are other assets that do have a high probability of exceeding the income capable of indexed universal life insurance. And how much they'll exceed it is circumstantial. It depends on an array of different factors. How old you are when you're looking to start this, when you intend to retire, what your overall taxability of other income sources will be, are all things that you should factor into whether or not indexed universal life insurance or whole life insurance makes sense for you as a retirement income strategy. But do be careful here, because indexed universal life insurance is one of the more manipulatable projections that could create inflated expectations that would be bad for your long-term retirement sustainability if you intend a certain degree of income from the indexed universal life policy that never materializes, and now you're chronically underfunded in other areas that perhaps you should have been putting more money into in order to create the income that you needed. So as you should plainly see by now, there is not a definitive answer. There is not one product to rule them all. Whole life insurance is more stable. Whole life insurance does speak to the people who like consistency. Indexed universal life insurance does involve a certain higher degree of volatility of year-over-year earnings, but in general, it's probably going to have a higher overall rate of return. There are pitfalls with both because people can implement poorly both policies, and it's important to work with somebody who understands the product very intimately. And if somebody tells you that one is always superior to the other, run away, because they don't know what they're talking about.